Have today's prices kept you from buying the home you want? What if you could have a similar buying power as you did when rates were below 4% in today's market? Well, upsizing usually means higher payments, but what if you could reduce your monthly interest and keep your equity accessible even after closing? Stay tuned for the pros and cons of using the AIO loan when upsizing to stretch your buying power. Let's get to the video. First, let's talk about the challenges in upsizing and buying a bigger home. Well, more square footage usually means a higher cost. The average home price has gone up $140,000 in the Grand Rapids area since 2020. So when you add in the higher interest rates, your buying power has shrunk significantly. So traditional mortgages lock away the equity that you had built in your current home, looking to use that to buy your next one, of course. It does help with payments. However, you just lost access to all that money. Also, renovations are harder to fund with that higher payment too. So sometimes the perfect move-up home in this area does require some updating. So it could take longer to make those updates when you've lost all the access to the equity. Here's how the AIO loan changes that game. So you can combine your checking and mortgage for easier cash flow. You can deposit your full income into the account, instantly reducing your principal balance, and use the available equity for upgrades after you move in. So this will raise the mortgage balance, of course. So if you watched my previous videos, we talked about that. Go back to what is the AIO loan if you're unfamiliar with it. And while your balance will go up, your income helps drop that balance significantly each month, rather than getting a second mortgage to make those repairs or saving that money. You're going to go faster with the AIO loan. And not only that, you can keep from draining your emergency savings account if you keep it separate from the AIO product. So what does this actually look like? Well, let's dive into a scenario and go through this. So say you are selling a $300,000 home and you're going to buy a $500,000 home. And let's say for the sake of this scenario, you have $200,000 in equity in that current home. The AIO gives you flexible access to most of that equity post-closing. So it's perfect for finishing a basement, adding a deck, or covering some unexpected expenses along the way. Let's go really quickly through the pros and cons of this. So you're gonna have flexibility during the transition. It's gonna be great for those who have a lot of money at the end of the month. So you're saving money. That's gonna help you reduce that principal balance, and you're gonna have some interest savings here as well. So the cons would be payment amounts can be fluctuating, and also it really requires some attention to detail on your cash flow each month. First of all, I'm gonna drop a disclaimer here. I'm not a loan officer. I'm just using this calculator that's available on the public. Reach out to me if you'd like it. So what we're gonna go through here is a scenario based on the AIO versus a 30-year fixed mortgage. I pulled rates at 7.25%. Obviously, those can fluctuate with what's going on in the market and also based on your current situation. So pulling it up here, we are financing $300,000 of this $500,000 property, and we will have a loan payment without taxes and insurance of about $2,000 a month. And with this next screenshot, you're gonna talk about your income and expenses. We're gonna use some round numbers here for easy maths. Let's say you make $6,500 a month, and between paying your property taxes and insurance and other monthly expenses, you pay out about $3,800 of that per month when you take into account the $2,000 principal payment on the mortgage, leaving you with about $653 a month in surplus. Now I'm gonna take a time out for an important strategy for the AIO loan, and it's to have as much time as possible once you deposit money into the bank before your expenses go out. So get creative with some strategies of maybe you have a separate account that pays bills and you just transfer money back and forth to that so you can keep paying down that principal balance. That's the key to this loan. Pay down that principal balance as fast as possible since your income is allowing you to do that. What are the results of this scenario? Well, if you look on the left, we have the AIO loan, and on the right, we have the traditional mortgage, 30-year mortgage. So who wouldn't want to save nearly 13 years on your mortgage and nearly $200,000 in interest? And not only that, do you plan on making less money in the next 17 years? Probably not. Will you get a tax refund? Probably. All of that can start snowballing and paying down this even faster than the 17.4 years in this example. Not only that, if you get in a pinch, let's say you have some unexpected bills, some medical expenses, and you don't have an HSA account that you've been investing in, it's going to be thousands of dollars out of pocket. You can use that equity in a pinch. So how does that sound to you? Are you a good candidate for this AIO loan? What'd you think of this scenario? I would love to hear from you. Please reach out in the comments or at one of the links below. Give me a call, text, or an email. Would love to go through some scenarios with you and introduce you to my AIO loan expert. Again, I'm a realtor. I'm just trying to give you solutions to this housing issue we have with so many people wanting to move up but just can't stomach that 7% interest rate. This could be the solution for you.